Passing a prop firm challenge can be tricky. Trading is difficult enough as it is, but add in those specific rules, targets, and restrictions. No wonder it becomes a stressful experience. No matter how you trade, one thing remains true: you cannot control the markets. But there is something that you can control, something that can give you an edge when you are day trading, something that you can use to your advantage to help you to pass a prop firm challenge. And in this video, I'm going to break it all down for you. So please remember to hit that like button, subscribe to the channel below, and let's get straight to it. To succeed in trading, there are 3 pillars that you must master. The first, strategy, your trading edge. Before you can even consider a prop firm challenge, you need a proven strategy, a trading edge that you use to consistently make profits trading. Your trading plan should outline your edge, something repeatable that gives you an advantage over time. The second pillar is mindset, the holy grail of trading. Many traders believe that there is a holy grail when it comes to trading and that it lies with strategy. They will spend hours searching for those indicators, searching for the correct setup, but they don't realize that the holy grail does exist, but it exists within your mind. It is your mindset, your ability to stay focused, to stay patient, disciplined, and most importantly, to stay emotionally aware. I won't dive too deep into this topic here, but I do have some exciting news to share. I'm putting the finishing touches on my Mindset Mastery for Traders program, a deep dive into market psychology, personal trading psychology, and building the right mindset that you need for profitability. If you're interested or you want to learn more, there is a link below in the description where you can join the free waiting list for updates on the launch. The third pillar, the one that you can control, is risk management, and it's absolutely essential if you want to pass a prop firm challenge. Every prop firm will have different rules and different targets, but one common element that prop firms share will be the maximum stop out level, the maximum loss on the account. This is usually a percentage of the account balance, and sometimes there will be a daily max loss limit as well. Believe it or not, when starting a prop firm challenge, your first priority should not be aiming to reach those targets. It should be trying your best to get away from that max stop out level as soon as possible. So how do we work out the correct risk per trade? Let's go through it step by step. I've been trading with the prop firm, the 5%ers, for some time now. As a prop firm, they are a great option if you want to trade a larger capital, where you can trade one of their account sizes and you both take a share of any profits that are made. But they don't stop there. As well as offering account sizes for trading, they also offer these extra features, including live trading room, free webinars and workshops, and one-on-one performance coaching. They have 3 different programs that they offer to traders: the Hypergrowth, High Stakes, and Bootcamp program. I'm currently funded with the Hypergrowth program, so I am trading that live account with the 5%ers and taking a split of profits that are made. And I'm currently enrolled in the High Stakes program challenge as well. And my favorite feature of the programs that the 5%ers offer that differ from any other prop firm out there is the fact that they have removed the time limit, which means that you have an unlimited amount of time to pass the program. This is a massive game changer, and it can really help you to avoid falling into a stressful situation when you are trading. Let's face it, trading can be stressful enough. If you want some more information, or if you're ready to have a go for yourself, do check out the link below in the description. How to calculate your risk for a prop firm challenge, a step-by-step guide to managing risk and maximizing your success. First of all, it's crucial to understand prop firm risk. Make sure that you read the small print and get every bit of information that you need when it comes to your max loss on your account and whether there is a max daily stop out level. Prop firms have very strict max loss limits. So for example, for myself with the 5%ers, it's a 6% max loss on my Hypergrowth program. This means that if I hit 6% or more losing, then I will effectively lose that account. I will blow it up. Smart risk management is the key to long-term success. You've got to be able to manage the losers. How exactly do we manage the losers? This is the one thing that we can control, and the first step is to determine how many losers you can handle. Using the example of the Hypergrowth program that I currently trade with the 5%ers, there is a 6% max stop out level. So if you risk 1% per trade, you only get 6 losers before you hit that max stop out. I don't know about you, but I don't feel comfortable trading knowing that I only have 6 attempts before I lose completely. It's way too risky. So what you need to ask yourself is how many losers can I handle before I recover? Risk management is a very personal thing, and one person will have a different risk management procedure to another, and they might both be completely right for that person. Personally, I prefer to have up to 20 losers. Now, I'm not saying that I experience 20 consecutive losers in a row often, but I know myself, I know how my mind works, and if I know that I have 20 losers as a buffer from 0 to hitting that max stop out level, I can trade much more comfortably. It keeps me calm and it helps me feel in control, and I know the importance of psychology and mindset when it comes to trading success. How to calculate your risk per trade. There is a formula that you can use. This is one that I have come up with, and it's very simple. It is the max loss stop out level, again using the example of 6%, divided by your preferred losing streak. You may be different from me. You may be comfortable having up to 10 losers, so you would divide your max loss by 10. That would give you what risk percentage you can use per trade. And yes, I forgot to say, guys, it's all in percentages. It might sound confusing, but believe me, it is so much easier. When I first started trading the stock market, I originally started off using currency, but switching my mindset when it comes to risk from a currency mindset to a percentage-based mindset completely changes the game. It's more professional and it helps you to have more control on your account. It takes you from a losing trader to a winning trader. For me, this formula applied would be the 6% max loss on that hypergrowth program divided by 20 trades. The amount that I am comfortable losing gives me 0.3. Well, this would be the risk that I would use per trade. So I would risk 0.3% per trade that I take. I know it doesn't sound that much, especially if you're used to risking a lot more. Maybe you're used to risking 1% per trade, maybe even more. But you've got to remember with funded accounts that the whole point is to get that funded account. It would be a large account size. So you can't get too hung up on these figures. You've got to trust in the long-term perspective, the scalability. The hypergrowth program over time scales up all the way to a $4 million account size. If I remember that, then I don't mind only risking 0.3% per trade, because that's still massive when you apply it to those large figures. Small risk equals sustainability and better decision making. But it doesn't end there. Even if you start out with a very small risk per trade, you can still scale up your risk as you win. Risk, it doesn't have to stay fixed. It can be adjusted as you grow and also as the markets are going through their different cycles. For example, for myself, once I get to 4% profit in my funded account, I double my risk. So I would double it from 0.3% risk per trade to 0.6% risk per trade. And as I continue to make more profit, that remains. But if I experience losers and I fall back underneath 4% profit, let's say I take a loser and I drop down to 2% profit, I would adjust my risk. So I would return to risking 0.3% per trade until I get back up over that 4% profit mark. Why? Because it protects my profits and it allows faster gains. It means that if I take losers, I can just reduce that. But once I get on a good roll, the market is in a good place, I'm making profits, it means I can make profits even quicker and I can exponentially grow my account. There are many reasons that I choose to do this. So first of all, it helps to reduce stress and emotional decision making, crucial for your trading psychology. It keeps a funded account safe whilst allowing growth. It avoids blowing up the account too soon. That can happen quite often for many traders, and it works with any prop firm challenge. One of the most common questions that I get asked on my channel is, how do I calculate what lot size to use per trade? Since we're talking about risk and risk per trade in this video, I thought it's a great opportunity to answer that question. So there are many tools out there that you can use to calculate your lot size, your position size per trade. A lot of them are paid tools, such as this one, Magic Keys. As well as being a risk management calculator, this allows you to manage trades. So you can close positions, you can close partial positions. It's a really useful tool. I have got a separate video with some more information, and there's a link below in the description if you want to check it out for yourself. But quite honestly, you don't need to pay for tools like that, because there are really good free options available as well, and I continue to use them if I don't have magic keys to hand. My favorite tool is the free position size calculator on my FX book. Let's go through an example together. Before I show you how to calculate your lot size on my FX book, I'm going to show you the example of the live trade that I took in the markets this week in my funded account. So I've taken this back in time to Monday the 10th of March. We're on pound dollar on the 15-minute time frame, and I took this trade during the London session. So this isn't going to be a big trade recap. I'm not going to go through the specifics of the strategy. We're focusing just on risk, but I just want to show you how I calculate risk when I take a trade, what I'm thinking about. Just skipping over the main points of my strategy, we got to push down a liquidity dip. The key daily level got tested, and as price surged up together with the uptrend we are seeing, I got in for a long position here. I don't just buy into a trade, I obviously make a plan. I got into this as price was down here as a buy stop order. I decided I was going to enter at this level. I was going to use a 20 pip stop. So this would have placed it right underneath the low of the day, and in line with having a positive profit loss ratio where I am looking to make more than I am risking. I was looking to make 2 times my risk. So I was risking 20 pips to make 40 pips. How do we convert these pips into percentage risk per trade, and how do we know what lot size to use? Granted, it can get confusing, but it's really easy. First step is to create your plan, figure out what you want to risk in terms of pips, 20 pips. Then you can find a free online position size calculator. There are many that different brokers offer. I like to use my FX book because it's the one that I used when I first started trading Forex, and quite honestly, it's just really simple, it works, and it's free. So I'm on myfxbook.com, and I'm going to hover over home, Forex calculators. They've got lots of different ones here. We're looking for position size calculator. And this is all it looks like. First of all, choose your currency pair. Well, I'm trading pound dollar. Account currency, so that is the currency of your account balance, and because it's my funded account, it is in dollars. Account size, this will vary, and I'm sure that you will just enter in your account size as it is. For me, with the funded account, even though I am in profit in my funded account, I always enter what the starting balance is, because with my funded account, whenever I hit 10% profit, it doubles and then I reset to a new account size. So I don't stray far from that initial opening balance. So I find it easier to just stick with that. My risk, as we worked out before, is 0.3. Unless I'm over 4% profits on the account, then I will double it. But personally, I just choose to take 2 positions out. So my risk always stays at 0.3. This is the important bit that will be tailored to your trade plan, the one we just did before on the charts. Stop loss in pips, and in my example, it was 20 pips. Calculate. And it will load up 3 different things. We've got a money value, so it'll tell you that your risk per trade, in this example, is $120. Units, so that's just how many units of that currency you're going to be purchasing. And the sizing, so that's the lot size you need to take. 0.6 lots. If I was going to double up, I could either double up the lot size, so I could choose 1.2 lots, or I could open 2 positions, both at 0.6 lots each. And just a quick little trick for you, something that I've been using for a long time now, because I mainly just trade pound dollar and I day trade. So I will take different size positions based on obviously the setup. Sometimes I'm using a 10 pip stop, sometimes it's a 20 pip stop. To make it easier so that I don't have to go on my FX book and do that calculation every time I want to trade, I simply make a note in TradingView. So if I just do a text here, and you'll see I've got a template saved. And this is the template that I have saved in TradingView, and all I've put here is 40k, HG for hyper growth, pound dollar, because that's the pair I tend to trade. I don't even know why I've got 5 pips there, because I never just take a 5 pip stop, but I have got them written down here just to make it quicker. And in this example, 20 pips, as we just worked out together on my FX book, it's 0.6. The figures in the brackets are the doubled up position sizes, just to make it easier to glance. It's one less calculation to work out in my head if I've got it all written out there. And it's that easy. And just to kind of piece this whole puzzle together for you guys, once I have worked out the plan on TradingView, I figured out the lot size I'm going to take. I hop into my broker, I set the trade, I enter my order. If it's a limit order, either a buy stop, sell stop, or limit. I also include my stop loss and take profit. And this is in my history here. This is the trade, the one that we just looked at on TradingView, and you can see 0.6 lots. That's the calculation we just did. It was a buy order, and I was aiming for 2 times what I was risking for the trade. Well, as we know, I was risking $120, so I was aiming to make $240. And then you can see here the profit, 243. I always make a little bit more, so the trade pays the commission. I always like to make the trade pay for itself so that I'm not at a loss. Net profit would be $240. Prop firm trading is all about risk management. Remember to never focus on hitting the target first. Always focus on protecting your account. Make good decisions that get you away from that max loss figure as soon as possible. Remember to use a risk per trade that allows you to have a large enough buffer just in case you have some consecutive losers. And you want to remember the importance of this in your mind as well. Don't give yourself unnecessary stress. You can always increase your risk strategically as you grow in profit so that you can still protect your account but double up those winners. Remembering to scale down when it is needed. And remember that mindset is just as important as strategy and risk management. Don't forget to join the waiting list for the Mindset Mastery for Traders program. It is linked in the description below. If you've enjoyed this video, please let me know by hitting that like button, subscribe to the channel, and I will catch you in my next video. Thanks for watching. Bye.